For decades, the global tax system has been built on a relatively simple principle: earn more, pay more. But this principle only works if everyone follows the same rules. And increasingly, they don't. While average workers see their income taxes withheld automatically from every paycheck, the ultra-wealthy have access to an entirely different tax code, one that's legal, complex, and remarkably effective at separating income from taxation. The gap between what they should owe and what they actually pay has become one of the defining features of modern inequality. So how do the rich actually avoid paying taxes? What methods are they using? And finally, what would it actually take to fix this broken system? The first thing to understand is that tax avoidance isn't the same as tax evasion, and that distinction matters. Tax evasion is illegal. It's when you lie on your tax return, hide income, or claim false deductions. Tax avoidance, on the other hand, is completely legal. It's when you use the rules of the tax code to minimize what you owe, often by exploiting loopholes that exist in the system. And these loopholes are everywhere, but they're not accidents. They're often deliberately written into law by legislators, sometimes at the behest of wealthy individuals and corporations who have the resources and connections to shape tax policy in their favor. Think about it for a second. How many tax accountants and lawyers do you think a typical middle-income family can afford to hire? 1? Maybe 2? Now compare that to a large corporation or a billionaire who might employ dozens of tax professionals whose entire job is to find legal ways to reduce their tax burden. That asymmetry is baked into the system, and it creates an advantage that goes beyond just having more money. It creates a different set of rules. One of the most common methods is income shifting, where high earners move income from high tax jurisdictions to low tax ones. Ireland has become famous as a corporate tax haven with a corporate tax rate of just 5% compared to the US federal rate of 21%. Tech companies and pharmaceutical firms set up intellectual property in Ireland and claim profits earned globally are actually earned there through creative accounting, which is entirely legal. Apple did this, routing billions of dollars of international profits through Irish subsidiaries and paying an effective tax rate that was a fraction of the statutory rate. Another version is when wealthy individuals move their residency to places like Monaco, Dubai, or the Cayman Islands, where they can conduct business globally while paying little in taxes. It's all legal, but requires resources that only the truly wealthy can access. Then there's capital gains deferral. When you sell an asset for a profit, that's taxable. But if you don't sell it and just let it appreciate year after year, you pay zero taxes on that unrealized gain, regardless of how massive it gets. A billionaire could theoretically live their entire life without selling enough assets to generate significant taxable income. The wealthy do this by taking loans against their assets, borrowing at low interest rates and using that money to live on, which isn't taxable income. Meanwhile, the asset keeps appreciating untaxed. Only when they eventually sell does a tax liability emerge. For most people, this is impossible because you need credit access that normal people don't get. But for the wealthy, it's a standard strategy. Then there's trusts and foundations. A wealthy person can put assets into a trust that distributes income to family members in lower tax brackets, reducing overall tax burden. Or they can create a charitable foundation, donate assets to it, claim a tax deduction, and use the foundation's money for causes they support, all with a tax break. Bill Gates did this, putting billions into a charitable foundation, getting tax deductions. And the foundation now wields enormous influence over global health policy while preserving wealth for his family. This works so well that the ultra-wealthy regularly use variations of these strategies. Some are ethically questionable, but they're all legal. Corporate tax avoidance works similarly, but at larger scale. One strategy is debt loading. A company takes on massive debt, which is tax deductible, because interest payments reduce profits. The debt goes to another company in the corporate structure, perhaps in a low-tax jurisdiction, which receives interest payments, but in a place where income is barely taxed. On paper, the profitable company has lower profits and therefore lower taxes. The cash moves between companies, but the tax is avoided. This is why some corporations report huge revenues but minimal taxable income. Another strategy is aggressive transfer pricing. A high-tax subsidiary buys products from a low-tax one at inflated prices, reducing its profits and taxes. The low-tax subsidiary books all those profits in a jurisdiction where they're barely taxed. The cash moves through the corporate structure to avoid taxation. Stock buybacks are another tool. When a company buys back its own shares, it's treated differently than dividends and results in less taxation for shareholders. The cash moves to shareholders with favourable tax treatment. Companies have returned trillions through buybacks rather than dividends, partly because of tax advantages. The wealthiest shareholders benefit most because they own the most shares. Then there's carried interest, where investment managers get paid as a percentage of profits they generate. This is treated as capital gains rather than ordinary income, taxed at a lower rate than normal wages. An investment manager can make hundreds of millions in annual compensation, but pay capital gains rates rather than higher income tax rates. It's a loophole debated for years, but remains legal in most countries. The complexity here is almost the point. The tax code in the United States is over 70,000 pages long. No normal person can understand all of it, and that creates opportunities. When something is that complicated, it's easy to hide things in plain sight, to use one rule to offset another, to structure transactions in ways that appear compliant, even if they violate the spirit of the law. And if a tax authority ever challenges you, you have armies of lawyers and accountants ready to defend your position in court, where the playing field is completely tilted in favour of whoever has more resources. So why haven't governments fixed this? Well, the first reason is that these loopholes have powerful beneficiaries who lobby hard to keep them. The second is that closing loopholes is globally coordinated, because if one country closes a loophole, people just move to another country that hasn't. So it requires international cooperation, which is incredibly difficult to achieve. Different countries have different tax philosophies, different financial interests, and different political pressures. A low-tax country like Ireland relies on attracting corporations through tax advantages, so closing those loopholes would hurt their economy. There have been some attempts at global coordination. The OECD developed something called the Base Erosion and Profit Shifting Initiative, or BEPS, which was designed to combat tax avoidance strategies. More recently, there was a global agreement in 2023 to implement a minimum corporate tax rate of 15%, which was supposed to stop the race to the bottom, where countries kept lowering their rates to attract corporations. But even with an agreement in place, implementation has been slow and loopholes remain. The reason is simple. Wealthy people and corporations are incredibly good at adapting. Close one loophole and 5 new ones open up, because the incentive to avoid taxes is enormous. When you're dealing with hundreds of millions or billions of dollars, even a 1% difference in tax rates is worth hiring entire teams of accountants and lawyers to exploit. For regular people, that calculus doesn't make sense. For the ultra-wealthy, it's just standard business practice. And then there's the enforcement problem. The IRS in the United States has been starved of funding for decades, which means they have fewer auditors relative to the population and less resources to pursue complex tax fraud. So, while the average person with a simple tax return has a high probability of being audited if they claim something suspicious, the wealthiest individuals and largest corporations, whose returns are far more complex, are audited less frequently. This creates a perverse incentive, where the more complicated and risky your tax strategy, the less likely you are to get caught. A major study by the IRS found that the wealthiest 1% of Americans are now audited at roughly the same rate as everyone else. But when they are audited, the cases take vastly longer and involve much more complexity. Meanwhile, funding for auditing the wealthy has dropped, which means fewer and fewer wealthy people face any scrutiny at all. The wealth gap created by this system is genuinely staggering. The effective tax rate for billionaires is often lower than for middle-class workers, not because of what they earn, but because of what they own. Warren Buffett famously pointed out that he pays a lower tax rate than his secretary, and despite being one of the richest people in the world. That's not because he's doing anything illegal. It's because capital gains, which make up most of his income, are taxed at lower rates than wages. A truck driver earning $50,000 a year might pay an effective rate of 20%. A billionaire whose wealth grows by $10 billion a year might pay an effective rate of 5% or less if they never sell their assets. The system is broken, and everyone knows it. So, what would it actually take to fix it? Well, it would require several things happening simultaneously. First, you'd need to change capital gains taxation, so it's taxed similarly to ordinary income. Second, you'd need to establish a wealth tax, where the ultra-wealthy pay a small percentage of their total net worth each year, not just on income or gains. Third, you'd need to fund tax enforcement adequately so that wealthy people and corporations face audits with regularity. Fourth, you'd need international coordination to prevent wealthy individuals and corporations from simply moving to lower tax jurisdictions. And fifth, you'd need to close the specific loopholes we talked about, like the carried interest loophole, the corporate debt loading strategy, and the use of trusts for tax avoidance. But here's the political problem. Each of these reforms would be opposed vehemently by the people and corporations who benefit from the current system. They have the resources to donate to political campaigns, to hire lobbyists, to shape public opinion. And most politicians are reluctant to implement policies that would anger wealthy donors. So even though most people would benefit from a fairer tax system, the people who would lose benefits have far more political power. This is the fundamental challenge. It's not that we don't know how to fix the system. It's that the system benefits those with the most power, and they're not interested in changing it. Some countries are starting to try. The UK implemented a windfall tax on energy companies. Several European countries are experimenting with wealth taxes, though they've had limited success due to implementation challenges and capital flight. But these are band-aids on a much larger problem. The truth is that the way the rich avoid paying taxes is largely legal, encouraged by the complexity of the tax code and defended by the political power of the wealthy. Until that changes, expect it to continue and expect the gap between what the rich pay and what the poor pay to keep growing. If you want to understand more about wealth inequality and how we ended up in a system where a few people control most of the world's resources, we've already made an entire video on that topic. You should be able to click that on your screen now. Thanks for watching, mate. Bye.